Right now, the headlines are, well, they're everywhere. Escalating conflict in the Middle East, Israel and Iran specifically.
Hmm.
And we all know whenever things heat up there, energy markets, they notice fast.
They absolutely do. It's like clockwork almost. Geopolitics, oil prices, they're tightly linked. This is just another very immediate example.
Exactly. So for this deep dive, we wanted to cut through some of the noise. We've got a specific analysis here.
Yeah, a report from ICICI Securities. It's dated just yesterday, June 16th, 2025.
Right. Titled Oil and Gas Crude Prices. Another conflict raises geopolitical premium, and they analyzed it the day after June 17th.
So our job today really is to unpack what this report is telling us about the immediate hit, the impact on global oil and gas right now.
We want to get into the nuts and bolts of that market reaction.
And crucially, zoom in on what it actually means for energy companies here in India.
Yeah.
The risks, maybe any upsides.
And pull out those specific numbers and details hidden in the analysis.
Yeah, because this isn't just like abstract market stuff floating around. It's about how events way over there directly translate into real financial impacts for big energy players. And, why that chain reaction matters to you.
Okay, so let's jump right in. The immediate reaction. What did the market signal first, according to the report?
Well, the report flags a really direct and incredibly fast response. Brent crude prices surged.
How much?
A full 7% jump. And this was just in the 2 days right before the report came out, so June 14th and 15th.
And that lines up perfectly with the timeline, right? Israel strikes on the 12th, 13th. Iran's retaliation on the 14th. So the market priced that risk in almost, well, instantly.
Pretty much. As of the report date, Brent was sitting around $75 a barrel.
Which is notably higher than ICI Securities' own forecast, wasn't it? Their base case.
Yeah, their base case for FY26 was $68 a barrel. So quite a jump above that already.
But it's interesting, the report also points out, even with that spike, $75 is still lower than the average we saw recently.
That's right. About $9 a barrel lower than the average price between fiscal 22 and 25.
So what does that suggest? That other factors are still playing a role.
It does suggest that. I mean, while the conflict is clearly adding this geopolitical premium right now, other things haven't just vanished. Maybe worries about global demand, the overall supply picture. They're still kind of capping the price, maybe.
Right. Which is key because, as the report notes, things had been relatively balanced for about a year.
Yeah, surprisingly stable. Even with the Russia-Ukraine war happening, prices were subdued.
And that was because of that mix, uncertain demand, but seemingly okay supplies.
Exactly. And this new conflict, well, it's the big thing, threatening to throw that balance off now.
Okay, so digging into the biggest risk. The report singles out one specific thing, doesn't it? The physical supply risk.
It does. It all comes down to geography, really. The Strait of Hormuz.
Ah, yes. And why is that particular stretch of water just so critical?
The numbers are pretty staggering when you look at them. Over 20% of all the world's oil shipped by sea goes through there.
20%.
And even more for gas. A full third of the world's liquefied natural gas, LNG.
Wow, a third. That's huge.
It's arguably the most important energy choke point anywhere on the planet.
And unlike some other routes, like, say, the Red Sea, where ships can go the long way around Africa.
Right. Expensive, but possible.
There's just no other way out by sea from the Persian Gulf, is there?
No alternative maritime route. None. It's the only way for huge producers like Saudi Arabia, UAE, Qatar, Kuwait.
All the big Gulf players.
All of them. So any serious disruption there, I mean, even a short one, it ripples outwards. A prolonged one, massive global economic impact.
The report also zooms in on Iran specifically. Now, despite sanctions, they've actually managed to ship more crude lately.
That's right, yeah. The report highlights that Iran's exports have climbed to over 1.6 million barrels per day.
Which is quite a bit. Where's it going?
The vast majority, over 2/3, is heading to China. So you've got this significant volume that's now potentially right in the firing line if things escalate.
And there have been concerns mentioned, haven't there, that actual oil and gas facilities in Iran could become targets?
Yes, that's a risk that's been floated. That would be, obviously, a much more direct hit on supply. Now, it's worth remembering, Iran has huge gas reserves, second largest in the world, actually.
But they don't export much gas.
Very little on the global market. Sanctions have really limited their ability to build the infrastructure, the LNG plants needed for export.
But this conflict, it could also derail their future plans. The report mentioned LNG capacity additions.
Exactly. They had plans, apparently, to add over 20 million tons per annum in TPA of LNG liquefaction capacity.
Okay.
If this conflict puts a stop to that or delays it significantly, that could actually impact the global LNG supply picture down the road. Fewer future supplies coming online.
And just to clarify for India, are direct imports from Iran?
Negligible, according to the report. India's been complying with the sanctions, so we're not really taking Iranian crude directly.
Okay, so let's pivot to the impact here on Indian companies. It's not the same for everyone, is it? The report draws a clear line.
Not at all. It's really a story of two different impacts. You've got the upstream producers first.
Like ONGC and Oil India.
Right. For them, higher crude prices are actually potentially good news for their bottom line and earnings upside.
Because crude oil is what they sell. Price goes up, they make more money per barrel.
Precisely. And the report gives us some sensitivity figures on that.
Yeah.
They estimate a $5 per barrel increase in the price they get could boost ONGC's profit after tax, their PIT, by about 9%. And for Oil India, it's even more sensitive, maybe a 10% PAT boost.
Okay, so clear potential upside there. But then the flip side?
The flip side, yeah, the downstream companies, the ones refining the crude and selling the fuels.
The OMCs, Indian Oil, BPCL, HPCL.
Exactly. For them, higher crude prices are a major downside risk.
Because crude is their input cost. It's their raw material.
It's their biggest cost, by far. So if that cost shoots up, and they can't immediately pass it all on to consumers at the pump,
which is often difficult, politically or otherwise.
Right. Then their margins get squeezed badly. Both the refining margins, the GRM, gross refining margin.
That gap between crude costs and product price.
Yes. And also their marketing margins, the profit on actually selling the petrol and diesel.
And the sensitivity numbers there are pretty dramatic, aren't they?
They really are. The report estimates just a $1 per barrel drop in the GRM could slash IOCL's earnings by 18%.
18% from just $1 on the refining side. Wow.
And the marketing margin impact is even more severe. A cut of just 2 rupees per liter.
Just 2 rupees.
Could cause earnings for these OMCs to plummet by a massive 57%.
57%. That just shows how exposed they are to that price pass-through issue.
Hugely exposed. And it's similar for gas companies, too, particularly those importing LNG.
Because LNG contracts are often linked to crude prices.
Many long-term contracts are, yes. So higher crude means higher LNG import costs.
Does the report quantify that?
It gives an example, moving from their base case, $68 crude, to the current $75 level. Could push up the average cost of gas consumed in India from about $9.08 per MMBtu to $10.02.
Okay, so a tangible cost increase there, too.
And think back to Hormuz again. Qatar is a huge LNG supplier for India.
And their ships go through the strait.
Almost all of them. So that risk at the choke point directly links to potentially higher gas costs for India.
What's really interesting, though, is the analysts' view in the report. They see these risks, especially for downstream, but they aren't slashing their earnings forecasts just yet.
No, not yet. They're explicitly maintaining their current estimates for now.
Yep.
But, and it's a big but, they're issuing a very clear warning.
A warning that revisions could come.
Absolutely. They're saying, look, the risks are up, things are volatile, we're watching closely, but we need more clarity before changing the numbers. It's very much a wait-and-see approach right now. Risk assessment mode.
And that caution seems sensible, especially given another point the report makes about broader market uncertainty.
Yeah, even before this latest conflict flared up, there was already disagreement among the big global energy agencies.
The IEA, OPEC, the US EIA?
Right. They have noticeably different forecasts for oil demand over the next few years, 2024 to 2026.
So even the top experts aren't quite sure about the underlying demand picture.
Exactly. That divergence signals a lot of baseline uncertainty about market fundamentals, even without this geopolitical overlay.
The report apparently has charts showing this stuff visually.
It does, yeah. You can see the chart showing Iran's rising exports highlights the volume now at risk. Another one shows the gap between those agency demand forecasts.
Underscoring the uncertainty.
Right. And of course, a chart showing that recent sharp spike in Brent, putting it in context near historical averages now, but with clear potential to go much higher if things worsen.
So looking ahead then, what's the advice? What's the outlook from this analysis?
Well, for investors, the message is pretty clear. Be cautious.
Monitor things closely.
Very closely. Keep an eye on crude prices, obviously, but also on how the geopolitical situation itself evolves day by day.
And for the downstream companies, the OMCs.
The strong implication is they really need to be thinking about strategic hedging. using financial tools to try and buffer themselves against this price volatility that can crush their margins.
Makes sense. And the short-term outlook.
Volatility is expected to continue. With prices already having jumped, the bias seems to be upwards for crude as long as this conflict stays active and that risk premium is there.
And longer term. Depends on the conflict's path, I suppose.
Entirely. Scenario 1. De-escalation. Tensions ease. If that happens, you'd expect the geopolitical premium to unwind and prices would likely fall back, driven more by pure supply demand.
Okay, but scenario 2.
Scenario 2. Escalation. And the report is crystal clear here. Escalation, especially if it significantly disrupts traffic through the Strait of Hormuz.
That's the nightmare scenario.
That is the absolute worst-case scenario laid out. It would have massive global economic consequences, not just energy prices. A potential severe, maybe sustained, spike in oil and gas costs worldwide.
So let's try and pull this together then. The core insight from digging into this ICICI report seems to be
that these geopolitical flare-ups, especially in the Middle East, aren't abstract. They have an immediate, measurable effect on energy markets.
Right, and they create these very specific risks, but also opportunities that hit companies completely differently.
Yeah, depending entirely on whether you're pulling the oil out of the ground or you're the one buying it to refine and sell, upstream versus downstream.
And the biggest single risk factor that just keeps popping up in this analysis
is the vulnerability of the Strait of Hormuz, that geographical choke point. Its potential disruption is flagged as the #1 supply risk here.
Ultimately, this market volatility, it's not just numbers on a screen, is it?
Not at all.
Yeah.
It really highlights how fragile these global energy supply chains can be.
And that has potential knock-on effects for the wider economy, for stability.
And eventually for the cost of energy that, you rely on every day.
This report, it gives us that really sharp snapshot from mid-June 2025, captures that immediate reaction. But given that wait-and-see stance from the analysts and that underlying disagreement about where global demand is even heading, what do you think is the most critical thing to watch now? Is it the day-to-day twists and turns of the conflict itself? Or is it trying to figure out that bigger picture of energy demand that even the experts seem divided on?
That's the question, isn't it? Something definitely to keep thinking about as this situation unfolds.